Okay, so welcome. Today we're bringing back Dion Beg of Kanga Mortgage. And Dion's going to walk us through the recent mortgage announcements and the changes that are coming up in the next couple of months. Um, so we have some important dates. So December 15th and January 15th. Two dates on the calendar that will be bringing a couple of changes. Do you want to tell us or sort of jump off Dion and tell us the first date, December 15th, what we can expect?
Yeah, so December 15th, there are two big changes happening to insured mortgages. So, guys, insured mortgages are mortgages where you're putting down less than 20%. And, generally speaking, that's people buying their first home. But more and more nowadays, based on the price of properties, people aren't able to put down 20% on their second or third or fifth home, depending on what they sell their previous home for. So,
Right.
the first thing I should say is let's clear the confusion around is insured mortgages or CMHC insurance only for first time homebuyers? And the answer is no. It's for anybody who's buying their principal residence or a secondary home for a family member, okay? And they have less than 20% down and they qualify under the standard criteria. So it often gets conflated as, first time home buyers only, but it's for anybody who would qualify for the mortgage who is buying their principal residence or a second home. Now, it's going to affect a whole bunch of people, and there are two big changes that are happening to insured mortgages on December 15th. The first is an extension of the amortization available. So, right now, if you go get an insured mortgage and you're putting down 5 or 10 or 15%, the longest amortization you can get today is 25 years. Okay. If you were putting down 20% or more, then you actually today you'd have access to a 30-year amortization. And that mortgage is not a high ratio insured mortgage. That would be a conventional mortgage, 20% down or more. Now, what will happen on December 15th is that 30-year amortization becomes available for any insured mortgage applicants. And that means that ultimately people's monthly payment will drop because the longer you take your mortgage amortization, the
Right.
smaller the payment. And so there's been a lot of people in the industry kind of throwing their hands up saying, oh, this is a terrible thing because what it does is it means that people are going to be in debt for longer. Okay. And I hear that because that is true, right? Um, on the flip side, I have the question, who decided that 25 years was the right amortization? Why not 20? Why not 15? Right? Who
Right.
decided that 25 was the correct number? But the thing is that's one point. The other point is yes, people might be in debt for longer. But if what this does is it drops their monthly payment to the tune of anywhere from 8 to 9%, which is the math that it rounds to. And, instead of that payment being $3,000 a month, it's $2,700 a month. And that extra $300 saving is the thing that allows a Canadian to actually buy a home. Then my point would be it's a better outcome than being a renter for the rest of your life.
Right.
Because being a renter for the rest of your life means all your money's gone. Yes, in the case where you get a 30-year AM instead of a 25, yes, you're going to end up paying more interest to the bank. That is true. But if it's the lesser of two evils, it's I'd rather pay an extra 50 grand to my bank than $1 million in rent to my landlord for the rest of my life and have nothing to show for it, right? So extended amortization is a
So
big one.
I have a question on that. I've heard people say that that means now the prices in Toronto or the GTA, I should say, have increased to that amount, like 1.5 million. That is that what we're saying now? Because it becomes way more unaffordable than 1 million. You know what I mean? So I've heard this type of talk coming from a lot of industry professionals. So I was just wondering what your take was on that.
Yeah. So what you're referring to there, Charlene, is the second big change beyond amortization, which is the increase of the upper limit on insurable
Mhm.
mortgages up from today 1 million up to 1.5 million. And yeah, the question is then, okay, does this mean that because sellers now know that buyers can get mortgage insurance and therefore can buy with a lower down payment and a longer amortization, would that automatically mean that that seller will increase the price? Okay, I can understand that side of the argument. On the other side, it's, well, if that property hasn't sold already in a market where things aren't transacting that quickly, do you really think that by increasing the price of the property by 100 grand, you have a better chance of selling the property? And we all know logic says no. It's
Right.
probably going to affect some segment of the market, right? But I would say in general, I don't see prices jacking up by that extra, little bit because of these changes.
And I
Okay.
and I think another consideration too is affordability. So just because the bank says that your limit has moved from 1 million to 1.5 million, it doesn't mean that that extra $500,000 is not insignificant to a buyer, right? So they still need to be able to afford that
Yeah,
piece. It's just the lender saying that we're okay in terms of whatever borrowing amount that you qualify for is within that range, right? If you still are strapped, if you're strapped at 1 million, you're still going to be in a tough position at 1.2, 1.5. It doesn't
yeah,
it doesn't
that's
really
correct.
matter.
And so let's be clear. I mean, if you were to use the full extent of these two changes, which is the lower down payment, a longer amortization, and a $1.5 million upper cap,
Hmm.
the people who qualify for that are people who have a $330,000 annualized household income, right? So it's going to be a very small segment of the market. Now, funnily enough, and anecdotally, in the last 3 weeks, I've had different conversations with three different couples who will actually fall into this category. Okay. And I'll give you an example of one. They currently own a property that they will sell for 900 grand. When they sell, they'll have about 200 grand for down payment on the next property. But the next property will be around 1.2 million. So they're going to be 50 grand short of 20% down. Okay. But they do have the household cash flow to make that happen. Right. So they are now considering this seriously because they have the ability to move. And you said an important word earlier, Greg, which is affordability. And I just want to talk about now, we're talking about November 2024. If I go back a year ago, I was talking, and this is another real story from inside my brokerage. I was speaking with some clients who last year they made really good household income. They were considering buying their first home. It
Mm.
would have been a 750 purchase price with 50 grand down. So they'd be borrowing 700 grand plus CMHC insurance. The payment back then, which is a function of interest rates and amortization, right? The
Yeah.
payment back then was going to be around $4,300, and they decided not to buy. Okay. Now today, or this past week or so, I spoke with the same couple, and we talked about these new changes that were coming on December 15th, which are in particular the longer amortization. This is also coinciding with the fact that last year in November interest rates were 6.5%, and now we're closer to 4.5%.
Mm.
So we've got a 2% drop in interest rates, and we've got a longer amortization. And this couple who last year was looking at a payment of 4,300 a month is now at $3,000 a month come
Wow.
December 15. That's a
Wow.
$1,300 saving, right? And now, of course, they're ready to buy.
That's
Okay.
amazing.
So this is what I'm seeing in affordability right now. These last year, 2 years, guys, it's been very hard. It's been
Mm.
very hard for a lot of people who just felt stuck. We've had
Hmm.
many people who are living in a home that is too small for them. The second child's come along, they can't live there anymore, but they had to stay in place because the numbers did not allow them to move.
Yeah.
And
Hmm.
now we're seeing this freeing up of this ability. I've already seen a major uptick. And I think come December 15th, this extension of amortization together with the interest rates dropping is likely going to lead to quite a busy new year.
Can I ask a question just on the amortization point? So I understand that some people have said, going from, 20 years, 25 years, 30 years is now putting debt onto Canadians for a longer period of time. And I sort of understand that argument. But I also think that from a purely wealth building perspective that I think they need to adjust also the idea of what debt is. And so I think the period of or that time frame of our parents of debt being bad, when you die you must have no debt. The reality is I think nowadays debt is a tool that allows you to build wealth. And again, not having any debt also sort of signals that your money isn't also working. So it's parked somewhere that maybe it's not doing what it should be doing either. And the second point was at least when you were to go out and purchase a house, and you call Dion and his team and they work the numbers for you and they put you on a 30-year amortization, barring massive interest rate spikes and swings, knowing that real estate tends to trend, in the long term, sort of in a relatively straight line, you kind of know that your payments are going to be decreasing relative to inflation in the future, right? So your prices aren't going to go through the roof. The adverse is true with rent. So you could be renting today for $2,000 a month, but 10 years from now, 4,000, 5,000 is not out of the picture. It's certainly possible, and that will always increase. So I think, yes, as you said, it'll be hard out of the gates now, Dion, but I think once people get accustomed to that affordability each month of, okay, we need to make X to afford Y, and that then, allows us to get to month two, three, four. Once they've got that under their belt, that really should be the most they'll ever pay, barring massive swings in interest rates, correct?
Yeah, well, I can't predict the future, but it's fair to say that we have been through a very interesting interest rate cycle where we're likely the high peaks are behind us, at least for the foreseeable future, right? So I've been having conversations this week. Let's just say this week and the last week, I spoke with 10 people who had to make an interest rate decision. And the majority of them, 7 out of 10, are leaning towards the variable rate at the moment because they believe what's been published, and they believe the economists at the banks when they say that interest rates are coming down, right?
Right.
And so we're taking a lot of people to those variable rates with the intention to ride those rates down over the next year or so. And I'll just point out that variable rates are still higher than fixed rates, but that could flip in a matter of 6 months. So that's where people are taking that calculated risk. And also, as it comes to building wealth in real estate, I'll give you a really simple example, which I think makes the math really simple. So let's say you were able to buy a property for 500 grand as a
Yep.
as a simple math here, and let's assume that property prices increase by 5% in 1 year, which is well below the 50-year average in the greater Golden Horseshoe area, right?
Right.
So what happens to a property that's worth 500 grand in 1 year if it increases by $5,000, sorry, by 5%, is that it increases by $25,000 in that 1 year.
Correct.
Okay. If you break that down monthly, that's just over $2,000 a month. Okay. So some people will say, oh, you know what? Owning is more expensive than renting on a monthly basis because the monthly payment is higher. Okay. They forget that part of that monthly payment is building equity by paying down their mortgage. Let's
Right.
just say that's $500. And in addition to that, they're getting $2,000 a month in appreciation. So the difference between renting and owning in this example that I put forward is that your personal net worth will grow by $2,500 a month in the ownership version than in the renting version.
Mhm.
And I know that there's a lot of people out there who'll say, oh, no, if you rent, it's cheaper. And then what you do is you take the money you save and then you invest it. My question is, what percentage of the population will actually execute on that plan, right? When people have extra cash, if they're not disciplined, and most of them aren't, most of us
No.
aren't, right?
No.
Then that money ends up in consumer expenses and is gone forever.
Yeah, and I think the other piece that I find interesting is when someone says that for them to invest, they need a dollar, right? So you can only invest what you tangibly have in an account somewhere. the benefit of real estate is that it's leveraged money, and assuming it's your principal residence, it's also amazing tax savings vehicle, right? So you could essentially, I could show up and I could say, Dion, I have $1. Dion can find a way as long as I qualify and everything makes sense. He'll give me four more dollars. Those $5 together will appreciate. And the appreciation from the extra $4 that I didn't have also comes back to me, which again, once you see that kind of math played out, it's sort of a
Mm.
no-brainer. Like, I think rent is a great thing as a transitional piece. You know, if you don't know exactly what you're going to do, instead of making a horrible real estate purchase decision, take some time to understand something, or maybe your finances aren't secure. Maybe you're in a job where it's, you know, it doesn't make sense to make the jump head first. But when everything does line up, I don't understand the rental piece. If you don't have extra money, like you said, to put into investment accounts or whatever, you're kind of shooting yourself in the foot. And there's a reason why they call it the rental trap. It's hard to get out of, right? So once you put the money down and you've committed to 12 months in that lease agreement, you have only several options, which is to time the real estate market so that it works perfectly with the end of your lease, which it never does.
Mm.
It flips over to month. And now it's the question of, okay, can I time it again 60 or 90 days out to make this work? And most people can't seem to make that leap in a very simple, easy way. It's a painful transition.
Yeah, and I think trying to line up dates of, buying and selling and moving out of property is probably like the least important thing. It's finding the asset that you know is going to serve your family long term.
Mm.
And yeah, sometimes that does mean things don't quite line up from a dates perspective, but it's a small price to pay when. And I always like to think, and this is where I think that the difference between some of my clients who have really succeeded and others who have just done okay is that they've really sat down and thought about a vision for their future.
Mm.
And too many of us make decisions in the moment, like, let's say you're hungry and you're at the store, you will eat the saltiest, sweetest, fattest piece of food available, and you'll make a bad decision because all you're
Yeah.
thinking about is your immediate needs, right?
Yeah.
Whereas if you were able to, again, with a nutrition thing, say, okay, well, let me eat something that's going to not just serve me now, but in 5 minutes and 5 days and 5 years from now. And the same goes for finances, right? In that if we are willing to make tough decisions and forego some lifestyle benefits now
Yeah.
that are going to serve your future self, then that's the right thing to do. And if you can sit down and visualize what that will mean for you in 10 years, then the immediate pain is all worth the while.
Yeah. Well said.
Yeah, absolutely right. So heading back to your example, you said, purchasing for 500,000. Sorry, it was the example before that where your clients had 700,000 to
Yes,
play
yes.
with. I'm assuming they're in the GTA, and just so that they know that there is a lot of product out there that will suit their needs right now. Like 700,000 3 years ago was, yeah, you need more money. You need more
Right.
money. But right now, there are a lot of properties that will suit their needs. So they're in a really good position.
Yeah, and funnily enough, I've had this conversation with a bunch of people at the moment where they can actually buy before December 15
Mhm.
because they don't necessarily need the 25-year AM, right?
Okay.
And so for some of my clients who have that financial ability, I'm actually saying, you know what, you might want to buy before then because after then, competition will increase.
Mm.
Right.
There'll be more people who can buy because the affordability is there. So we're in this little 1 month window of time right now
Yeah.
where I'm working with maybe 3 clients right now who have taken that message and they're actively working with their realtors to try and buy before December 15.
Valid
Mm-hmm.
point.
Good plan. Good plan.
Mm.
Do you find, Dion, that a lot of, I guess, first-time buyers or younger buyers tend to watch market activity as a sign to then also participate? So, like what
That's
we've seen
yes.
since COVID is there are lots of great opportunities to purchase because competition is sort of non-existent. So if your affordability hasn't changed, and you're just watching market activity, it would seem to me that what you said is absolutely right. But why don't more people take advantage of that time or that opportunity, as opposed to waiting for I guess social proof and validation that the
Mm.
market is active. I
Yeah.
understand in terms of seeing enough quantity, but
Mm.
I think what you said sort of hits the nail on the head. That's a great time to be out hunting.
Yeah, and I mean, I think it's not just young people, it's just human nature, human behavior, which is
Mhm.
I'm not going to buy if nobody else is buying. And then oh, if everybody else is buying, that's when I'm buying, right? It's just you want to be part of the crowd. And
Yeah.
I think it's Warren Buffett's, this has been quoted a million times. They say the time to buy is when there's blood in the streets, including your own blood, right? So this is where the people who are brave enough to buy when things are not perfect are probably the ones who are going to benefit in 6 to 12 months from now. And if you were to wait 6 to 12 months, then yeah, you'll be buying in a much more competitive environment. And again, that's the messaging we've been putting out to. We've got I've never in my life as a mortgage broker, which has spanned nearly 20 years now, I've never had more pre-approvals sitting on the shelf than before.
Oh
That
yeah.
is, we've spoken with so many people, we've run the numbers, they know what's possible. And generally speaking, in a regular market, they'll move forward within 2 to 5 months. But
Mm.
we have files sitting on the shelf for 6 to 12 to 18 months. And
Yeah.
right now, we're actually calling these people and saying, hey, do you realize what is now possible, based on the lower payments, the stretch and amortization. So people are slowly waking up to that idea. I feel like, yeah, there's going to be a turn, and it's not going to happen like December 15 is the date, but it's not going to happen December. It's going to happen March.
Yeah.
And that's when I think we're going to see a bit of a frenzy in the spring market from what I can gather based on the feedback so far.
Yeah, I believe so as well. So these CMHC rules are, and just for the ease of understanding, CMHC is the Canadian Mortgage and Housing Corporation. So that means it's countrywide as opposed to province. Is that correct?
Yeah, so the history that you are correct. It's actually a government-backed insurance company,
Mhm.
and the reason that it was created was that back in the day, you had to put 20% down when you were buying your home, right? And what they discovered was that saving that money was a hurdle for many good Canadians with good incomes and good credit, but they just weren't able to save, the $20,000 or $50,000 for the down payment. And so basically, the government stepped in and said, okay, and they went to the banks and they said, okay, banks, we know that these guys are creditworthy, um, but we understand that you banks have obligations to your shareholders and risk analysis. And so what we will do is, if you fund these clients 100 grand to buy their house, and they default, and you have to sell their house for $90,000, and you're out of pocket 10 grand, CMHC would cover that 10 grand. And that's what CMHC, or mortgage default insurance, is what we're talking about here.
Mhm.
And so this basically facilitated the ability for people to buy with less than 20% down. And just so you'll know, like the default rate in Canada is less than 0.3%, meaning 3 out of every 1,000 houses might have this issue. Whereas in America, it's actually 10 times that number, right?
Mhm.
Mhm.
So we have very, very low default rates in this country.
Even now, Dion, with the
Even now, it's ticked up. It's ticked up. It was
yes,
lower than the number I just quoted you just now. So I'm
right.
giving you today's default rates, which is
Oh, got
still
it, got it.
exceptionally low. And if you think about it, guys, if you are struggling financially, what do you pay first? Do you pay your credit card? Do you pay your car payment, or do you pay your shelter cost? You always pay your
Shelter.
shelter cost,
Yeah,
right?
shelter.
And that's where, in the order of priority of debt repayment, the mortgage is the last thing to go. And what I will say, though, is that if you look at the last 12 months, people have started to default on credit cards and vehicles. So the next thing there is mortgages. And yeah,
Mm.
I think you can expect a bit of an uptick in that segment, right? But what I will say is, I feel like people will sell their home before the bank will, right?
Right.
So, and I think, again, because we're going into this market where I feel like there's going to be a little bit of an uptick, those people who were waiting to sell their home will now sell their home. So it's possible that because the market indicators are better, the people who are financially struggling will actually be bringing their home to market, which might mean even more inventory this coming spring market.
Right. Um, One thing you mentioned, which sort of popped into my head, was in regards to the CMHC story, and it might be good to get clarification on the interest rates for insured versus non-insured mortgages, because I think that confuses some people. So people who have a non-conventional mortgage, meaning, they're below the 20% threshold,
Mm.
they require an insured mortgage,
Yes.
but against someone who, say, has saved 30% to put down, but their
Yep.
mortgage is not insured,
Yes.
the insured person with less money down actually can get a better rate.
Better interest rate. And doesn't
Yeah.
that just makes no logical sense, does it?
No, it doesn't.
So for a lot of young people or buyers, it does seem almost like they're penalized, but I understand the rationale from, a lender's perspective. The risk obviously is less.
Yeah. So put simply, and I'll give you this example. Let's say we've got two brothers buying two identical houses side by side. Brother one puts down 5%, brother two puts down 20%. Okay. And and they go to the exact same bank. Let's just call it the
Mm,
green bank.
okay.
And brother number one, who puts down less, gets an interest rate of 4.3. And brother number two, who puts down 20%, gets a higher interest rate of 4.6. And you're like, well, why? Why is this brother here is putting 20% down? Why is he getting penalized with a higher interest rate? And it's because this mortgage from the brother number one, who is putting down just 5%, the green bank doesn't take the risk in the event that this person defaults on their mortgage, because that risk is sold to or insured by CMHC or one of the other two insurance companies. And so there's zero risk to the green bank by lending insured mortgages, because in the case of default, it's not their problem. And that's why, and I have to explain this more than once a week, why interest rates on conventional mortgages are higher than on insured mortgages.
Mm.
Mm-hmm.
Still hard to
No
wrap my head
idea.
around it, but
Good question, Greg. I had no idea.
learn something new every day.
Yeah.
All
Yeah.
right.
I mean, look, ask yourself the question: if you could lend money with zero risk versus lend money with a little bit of risk in the event that, there's a default, I have to get a lawyer involved, I have to get a real estate agent involved, I have to get back my money. Which of those two risks would you like? I take the first risk every day, right?
Yeah.
Yeah.
Right.
Yeah.
Now,
Yeah.
you were going to explain about insurance and the different insurance types because I don't know that necessarily people really understand.
Yes. Okay, great. So thanks for the question. There are three separate types of insurance. Okay. The first one, which we've discussed quite a bit here, is what we call mortgage default insurance. Everybody knows that as CMHC, but just know that CMHC is one of several companies that offers default mortgage insurance. The beneficiary of that insurance is not you, it is the bank, right? As explained, in the event that a borrower defaults, the bank will collect an insurance payout from that insurance company in the event that there is a shortfall in recovery of their debt. Okay, so that is mortgage default insurance, where the beneficiary is the lender. The other type of insurance that people confuse with that one is also often called mortgage insurance. But what it really is life insurance in the event of your death that will pay off your mortgage. Okay. So
Mm.
that's the second type of insurance that people should consider at the time of establishing a mortgage. And in my opinion, you should look beyond a policy that only covers payout of the mortgage. In my opinion, you should probably get a more widely covering regular life insurance, which gives you a payout, which allows you to determine your beneficiary determine what to do with that money. Maybe they'll pay out their mortgage, or maybe they'll put it in the bank and monthly pay the mortgage to sustain themselves over the next 20 or 30 years, right?
Mm.
So that's the second type of insurance that you should really be talking about when you go into more debt. And then the third type of insurance when you buy a house is property insurance, which covers, the idea that, your house might burn down or get flooded or whatever that might be. So at the time of arranging financing, just know that there's three types of insurance that may be discussed. And if you need clarification on these things, again, you should talk with your mortgage provider, mortgage broker, realtor about it at the time.
A follow-up question I have. Is there more than one company that is like CMHC?
Yes, there are three. There are
Three.
three insurance companies. Everybody just knows CMHC because they're
Yes.
the biggest, and so, but yeah, just know that they're not the only one.
Okay, thank you.
All right. So does that take us to our January 15th date?
Yes. So this is the next big sort of milestone for change in mortgage insurance. It is a very specialized product, and I think that fewer than maybe 5% of the Canadian population would even consider using this product. Okay. And this is what it is. It's a product which allows you to access equity from your home to build additional units in your property. Okay. So the most basic example would be you have a house with an unfinished basement and you need $100,000 to finish that basement. And if you were to finish it, you would then be able to create a secondary suite. So it's not just finishing the basement, it's the creation of a new livable, self-contained legal unit. Okay. And so basically, the government is incentivizing homeowners to become property developers, right? And if you look beyond this and look at the bigger landscape of what's been going on in the Canadian economy and Canadian politics in the last year or so, it's the idea that we need to build more houses. Mm. And you realtors will know that developers have stopped developing because the numbers make no sense.
Yeah.
And so if I was a little bit cynical, and I've known to be at times, you might look at this and say, is this the government's solution to create this extra 250,000 houses a year every year for the next 10 years? Is it?
You can continue, but I'm gonna weigh in and say 5% of the population of Canada can take advantage potentially of this particular product that they're trying to hand to you,
Well,
right?
no, sorry. So I'm saying it's available to anybody who qualifies, but the people who
Okay.
would even entertain this may be fewer than 5%, because how many people out there really, really want to go into a construction project on their principal residence, right? And many people don't.
Right. And then that begs the question, and I'm gonna say that I'm a very cynical person. Um, why would they not make a product that more of the population is inclined to use? Do you understand
Well,
what I
okay.
mean?
So
Not that
yeah,
you
so
would know the answer to that, but it
yeah,
just
yeah. So look, I guess the thing here is, I want you to imagine a person who lives in $1 million home who has a $500,000 mortgage. Okay. And there's many, many people in that type of scenario right now.
Mhm.
And they have an unfinished basement. Okay. Now, if they were to finish the basement, it might cost 100 grand. And then if they finish that basement, it should rent for anywhere from 1,500 to 2,300, depending on, what it is. It's a decent return on investment. Okay. Now, that person in that example, guys, they don't need an insured mortgage to do that. They can do that conventionally. They have enough equity in their home to not exceed 80%. They only
Right.
need 100 grand, right? And they've only got a mortgage of 500. So if people really wanted to do this, they'd be doing it already.
Hmm.
Okay. And this is designed for those people who have the $1 million home and already have an 800 grand mortgage and need an extra 100 grand to take them to 90% loan to value, right? This is designed for those people, right? So if this was something that the Canadian public really truly desired to do, there'd be many, many people doing it already. Yeah.
Got it.
So let me play devil's advocate for a
Oh, I already
second.
did that.
No, no, I'm going to take it to the next level. So, what is the opportunity here that perhaps people are missing? And are there limitations on what you could do with that secondary suite? So, for instance, let's say you had, an adult child who can't afford, a $600,000 condo right now, but we do have a basement that theoretically could become an apartment. Is there an option in that idea to then create this basement suite, use it for, those purposes? What does the bank require in terms of,
Okay.
getting those
So,
finances,
you
and
know
what do
what?
they need to validate in terms of income
It's
coming
been a
back
minute
in?
since I read the fine print, but and forgive me if I'm wrong here, and we should all go fact check this after the case, okay, after we record here. But I believe that the requirement is that the creation of this next unit cannot be for the purpose of housing family.
Hmm.
Seriously?
So
Okay.
if you again think about the reasoning as to why they've created this, it's because they want to provide housing
For others.
to others, right?
Okay, but I mean, I'm not taking it to task here, Dion, but it kind of makes no sense to me.
And I'm
So that
Australian. I'm not even Canadian. So don't shoot the messenger. This is your people made this stuff up, all right?
your people, I love it.
You Canadians.
So, right? But listen, if my family member needs a place to live, so they're already out there in the rental world, why don't I bring them to my newly created legal basement apartment with the money from the government? And they can free up a space for another family to live. That
I'm looking up the number for Justin Trudeau's office. I'll send it to you. Uh, and you can just,
I was in Ottawa 2 weeks ago. I saw him. He blew
Uh,
by me, just saying.
I think you might want to go back to Ottawa and see if he's around. But I mean, to Charlene's point, I mean, that really would solve a lot of problems for actual Canadians in terms of finding housing for their kids, something that's adequate so they can, that bridge that gap between, finishing school and when Dion says, yes, you can go and shop now. And also, multi-generational living in terms of like taking care of, an elderly parent, like
so
retrofitting a home. And this could have
all of
been
that
a,
is
a great
true.
idea.
All of that is true, but I think that very few people need this insurance product. They can do it conventionally today, right? If they really, really want to. And actually, I'll just, again, another story out of the last little while. As it relates to a bunch of stuff we've talked about today, I have a client who is helping their child buy their first home. Okay. The
Mm,
child is a single guy, he's unattached, and he wants to buy his first home. And they were looking at something like 800, 900 grand. But then they came across a 4 unit property, okay, which was at around 1.3 million, significantly more in price
mm,
point. But when they sat down and they did the math and they said, okay, after December 15th, we can buy this property with less than 20% down, with a 30-year amortization, right? With getting the first time home buyers land transfer tax rebate, like all of those things.
yeah.
And my son can live in one of the units and we can rent out the other three.
Mhm.
the cost of monthly ownership on that more expensive asset is cheaper than him going and buying a single family townhouse for 800 or 900 grand, right?
Yeah.
So this is an interesting way that people are looking at, these new rules as they may relate to property ownership going forward. And it may be something to consider for, well, this has always been the case. We call that the basement mortgage helper, right?
Mhm.
Where if you could buy that property and rent out the basement and you get a couple $100, $1,000 a month, it helps you pay your mortgage.
Mhm.
I feel like there may be opportunity for that now, especially in these more expensive multi units that aren't just 2 units, but up to 4 units.
Yeah.
Mhm.
Hmm. That's the
All
next
right.
challenge.
Yeah.
Mm.
But I do like what you said. I think too many of today's buyers are not creative enough to figure out the affordability piece. So, they're looking for perfect out of the gates. And I think backing themselves up into a spot where they can just barely afford today's property. But that doesn't leave a lot of breathing room in terms of life changes or deciding, you know what, we're going to have a family, so we're going to go from two incomes down to one, or even just a change in career, right? Get a layoff or something happens and you've got a 3 to 6 month window with no money coming in. Um, Having something with rental or the ability to improve and add equity, I think is one of those almost like a lost art nowadays, it seems. I think,
So, and I think this is a great point to end on, which is another story that came out of some conversations this week. I was talking with this lady, she's Vietnamese, and she's in her 50s. And she and her husband want to go and spend extended periods of time back in Vietnam.
hmm,
Okay. And as I'm talking to her and we're listing off her properties, between them, they own 6 properties. And I said, well,
wow.
you've done really well for yourself. And, how did this all start? Because I love to hear people's origin stories.
Mhm.
And she said for 4 years, when they bought their very first home, she and her husband lived in the basement and they rented the upstairs.
Yeah.
And all their friends said they were crazy. Why would they be choosing to live in a basement?
Hmm.
But again, these are people who had a vision for their future,
Mhm.
right? These are people who are willing to forego little things now to build a better life tomorrow. And now we're setting them up so that they can go and spend 6 months every year in Vietnam with their family
Yeah.
because they were willing to do things that other people weren't willing to do. And guys, it's always the case. You've got to give a little. You've got to try harder than you probably ever have before, right?
Yeah,
At the very start of your journey in real estate. But if you can stick with it, then it's going to pay off.
for sure.
Mhm. Yeah, that makes a lot
Wow.
of sense. Okay, look, we're not going to let you leave until we ask you what your prediction is for December 4th. The interest rate announcement, and we're going to hold you to it. I'm kidding, we're not. Just what is
Yeah.
your prediction? Because I've heard people say, 0.50 again. Now that the election's over in the US, people have kind of like changed their minds. They're like back at 0.25. What do you think? And do you think the election has anything to do with it?
Um, okay. So does the election have anything to do with it? Yeah, probably. And to the extent that anybody who knows the platform on which Donald Trump ran, it's a platform where it's let's go big, which generally means more inflation ahead,
Mhm.
right? And so we've all been dealing with inflation for the last couple of years, right? Canada's central bank, the US Fed were on this path to start to constrain stuff. Sorry, had constrained stuff and now felt comfortable enough that the economies were at a point where we could start to release the chokehold and therefore make interest rates lower faster, right?
Mhm.
So this is where that tone or that feeling, sentiment in the market might have changed because of the new leader in the United States. In terms of where do I think rates will be come December? Yeah, I don't think it's no change. There will be a change. Will it be 0.25 or 0.50? Frankly, I don't even think the Bank of Canada knows. until December what they're going to do. And they're going to be watching economic data as it relates to the sentiment down south. There's a whole, we won't go too deep into it, but the Canadian dollar is as low as it's been in the past decade or so, which is part of partly tied to the fact that we moved our interest rates lower faster than the US did. And so there's a lot to consider beyond just, say, the real estate market that we operate in.
Mhm.
But I do think that we could reasonably expect 0.25 and optimistically expect half.
Hmm.
I'm going to be optimistic on this one and not be, pessimistic or I'm going to be optimistic. I'm going to say 0.50.
All right, let's take some bets.
Well, I think the punchline is regardless of what number they go with, if there's a rate cut, I think it's a positive signal to buyers to get out and be active.
Yeah, yeah. It's the point where, and I don't know if we said this on the last call, but I've said this a lot recently, which is marry the price and date the rate, right? Which is you lock in today's price, knowing that rates will likely be on the downswing. When rates drop, prices go up. So the choice is, are you willing to take a little bit of a gamble, but really knowing the lay of the land ahead?
Yeah.
It's quite a small gamble in today's world to be moving forward. If you find a property that meets your criteria and is within your price range, my advice would be to move forward now.
I agree.
Hmm.
I agree.
Beautiful.
Well, once again, you provided us with a whole lot to think about. Some really valuable insights. Your knowledge, your experience is yet again
Happy
exceptional. Really,
to help, man.
no,
Yeah.
for sure. I mean, anyone who's looking for a great mortgage team, definitely hit up Dion. Again, we will put links and everything at the end of the video. But we appreciate you coming on and sharing this knowledge and clearing up a lot of things that even for us is a bit of a gray area. So
Yeah, happy to,
much
man.
appreciated.
Look forward to the next opportunity. Thanks.